Hello, and welcome to another Daily Dose of Insights powered by Container Exchange. My name is Christian, and every other day we bring to you the key news, stories, and data points that move container markets and hence your business. Today is Monday, so we have Macro Monday at Container Exchange, where we typically look at the week ahead, the economic indicators that are coming in and that will influence markets this week. Let me quickly share my screen to give you a little bit more guidance on what I'm talking about. This is a bit of a long list, so apologies, but it's a very busy week in terms of economic indicators. We start off today with a massive focus on Europe. Some of the data has already come in, and this will continue throughout the day. And most of this data actually points to a further cooling of economic activity, a further sort of sliding into a recession in Europe and specifically in Germany. So of course, close to home for us. So German inflation expected to come in lower. This is good news, as this means that monetary policy, tightening of credit and interest rates is working. So this is coming in lower at 4 versus 4.5% year on year, as the previous indicator. And this has already been sort of preempted a little bit as North Rhine-Westphalia has already published its results this morning, where inflation was only 3.1%. So very positive news on this end. This, however, is also driven by, as I said, cooling of economic activity. So German GDP expected minus 0.7% year over year. So German economy is shrinking at the moment. And very similar picture across other European or Euro area nations, not so negatively, but still sort of at the brink of a recession or in recession already. This continues on Tuesday with other Euro area economic indicators. For example, the overall GDP only 0.2%, so just above the zero line year over year, and also the inflation rate expected to further cool at 3.2%. This underscores or underlines that there's likely no further tightening on the ECB level for at least the foreseeable future. And then on Wednesday, we take the jump over the Atlantic. Fed interest rates expected stable at 5.5%. Here, the picture is a little bit different than in Europe. The labor market is very strong. GDP growth is very strong. And so there might be further tightening of monetary policy in the books in the coming weeks or months, compared to Europe, of course, where we don't believe this is true, at least in the foreseeable future. And yeah, on Friday, so I actually put this as a sub-bullet here. US labor market data is also expected to come in strong with only 3.8% unemployment rate. This is stable versus the previous issuance of the indicator, and an addition of 188K non-farm payroll jobs. And then, last but not least, the Bank of England also, of course, has to make a decision, and that happens on Thursday. Also, there, interest rates expected stable at here 5.25%. Actually, this is not coming in on Thursday. This was still a note from last week. So yeah, Bank of England interest rates expected stable at 5.5%. Very much in line with the other two major banks, central banks, and yeah, a bit of a tale of two sides here on both sides of the Atlantic this week. That's it from us for today. A very busy week ahead, as you could see. That's why I had to rush through this also a little bit. Apologies for that. Have a fantastic start into the week, and see you all on Wednesday. Take care.